Fed thought they were giving the markets what they wanted. The markets would like to go on having this unbelievable love affair with growth stocks and with the S&P 500 index forever, because it's gone on longer than the love affair with growth stocks and the love affair with the index has gone on. So what you've got here is the beginning forces. Actually, if you go back 1 year ago, and if you tracked the four main FANG stocks we consider to be Facebook, Alphabet, or Amazon, Netflix, and Google, they're all lower than a year ago, even before the sell-off this last week. Every single one of them has gone 12 months without making any money. Yet, if you go back and look at the transcripts of your shows for the last 6 to 12 months, 80% of the time is talking about them. And what's left of the other 20% of the time has been talking about beyond meat and beyond belief money-losing IPOs that are literally a train wreck. Because think of microeconomics. By the way, I'm not a very big fan of macroeconomics. I apologize to Steve and Lindsay. But on a micro basis, if you substantially increase the number of growth stocks available, and you don't change the demand for growth stocks, what happens to the price of growth stocks? They go down.
All right.
Now, on the opposite side, value companies are disappearing. Allergan gets bought out. Anadarko gets bought out. The number of value stocks is decreasing, but there's just been no demand for value stocks.
Well, Nancy, I know you're a little more sympathetic to some of the big tech names in particular. I don't know if you want to comment there. Ironically, you guys have some overlap, some agreement on the names that you do think are attractive here. I think Amgen might be one area in particular of agreement. But Nancy, address what Bill just said about the big tech names.
Yeah, well, thank you, Kelly. And hey, Bill, listen, I think, as I have for some time, that now's the time when you want to be focused on companies that have a dividend-paying culture and are paying an above-market dividend yield, which is well above the 10-year again. So these are companies that raise their dividends in anticipation of future earnings growth, and you get data as well as a growing income stream from the dividend increase. So these are some of the large cap tech names, but many of the sort of usual suspects in healthcare, in consumer discretionary, even energy. So I do think when you're worried, as many investors become when we get these kinds of corrections, which, by the way, we get every year, you want to be focused on companies that are paying you to wait for the management teams to sort things out.